Welcome back, everyone. My name is Adam. I have Rusmin.
Hello.
Victor.
Hi, everyone.
Thank you once again for joining us. Today we're going to talk about Hongkong Land.
Yep.
Property developer.
Yep.
But I think there's a bit of news recently that caused the stock to jump in price.
Yep.
And year to date is gone up, I think, over 30%.
Yep.
I think 38% as of this recording. So we want to find out what happened with Hongkong Land. Why did the stock jump like that? And whether, there's an opportunity to have a look at it, even despite this jump. And we did cover Hongkong Land 1 year ago.
Yes, 1 year ago.
So let's recap what we said then.
Yeah, so if you go back to our video around September 1 year ago, the title of the thing is this Grade A Hong Kong property undervalued? So we covered that, right? So during that point of time, I did a discount to all their assets in the first half of 2023's result.
Okay.
So you can see that after I discounted over here, right, the book value was $6.15. And the share price at the point of time was about $3.60. Okay, but because of the property was down and all this, we say that it may drag further, it may go down further, but you never know. But based on current, right, the risk reward is very high at the point of time when we said, right? And basically you are being paid to wait for the recovery of the property market as you go along. Okay, but of course, with the recent news, it's sort of like accelerate the recovery already.
Okay, so when you say the risk to reward ratio is high, it means there's a good bet. There's a high reward for
the risk that we're taking.
Okay, so just to make that clear. So I think before we jump into the news and why it's jumped, maybe a really quick introduction of Hongkong Land's business model for those who don't already know what they do.
Yeah, so basically they own a bunch of investment properties in Hong Kong. So I think if you go to Hong Kong, you take train to the central MTR, right? So they have this cluster of 12 commercial buildings that are interconnected each other, right? And I was there, I think in May this year. It was like a huge gigantic building.
I was in Hong Kong recently too.
Yeah,
I didn't know which.
You
was
noticed
which.
that. Yeah, but
too many buildings.
Once you go to the Hong Kong Island and you take a train there, you actually land on somehow you will be in their properties, right? Because they have like a bunch of cluster of it, right? And most of these are actually freehold. I would say 999, but it's as good as freehold, and some of them are extendable.
Very great A office.
Very prime, premium, central premium location in the Hong Kong area. So even like in the current market situation, like huge crisis, property prices are coming down. There's actually a flight to quality. So that's the kind of asset they actually focus at, right? And they actually bought this plot of land like long time ago, and it just happened to be at that central of Hong Kong, right? On top of that, of course, they also have Singapore properties. I think you should be very familiar with Marina Bay Financial Centre, One Raffles Quay, which both of these commercial properties, they already own 1/3 of the interest, right? The other 2/3, I think, is actually listed under Capital REITs and also Suntec, right? And of course, they also have like One Raffles Link, which they fully own, including the CityLink Mall, right? And yeah, so basically a bunch of their investment, or rather their result, right, actually come from their rental income, right? Which above it is actually come from Hong Kong, account about 2/3 of it, and then Singapore account about 10%, and the rest come from the rest of the Asia, including China and Macau, right? So if you look at their operating profit by business segment, basically this business actually 70 to 80% of their income, operating income, actually come from rental income. So actually that gives this business a very stable, business, and that actually allows them to pay a very stable dividend over time. Okay, and that has been like the case for Hong Kong Land. Okay, and of course at the time when we covered it, the share price had been coming down, and the yield was like pretty attractive. I remember it's like 5% to 6%, right? And and until recently, I think when the news came out that they're going to do a strategic review on Hong Kong Land, right, and this is where the start of the catalyst, right? The real catalyst we are seeing in Hong Kong Land.
All right, so the stock recently jumped about 15-18%. Thereabouts. Year to date, I think it's 38%, like I said. So I think a lot of it was, if you take a look at the chart, this is like the last couple of weeks, it's just like, it just went up. So we want to find out what happened there.
Yeah, so if you look at the announcement that made by the new CEO, Michael Smith, he actually joined this company, I think, late last year. And he was previously with Mapletree Investment, right? And so he succeeded the new CEO, and then he came in and then he do a reboot, right, for the whole Hong Kong Land. And one of the main things they did was, he's going to do is basically to stop their investment in the development business. Okay, right? It's essentially what Capital Land has did with their development business, where they spin it off, right? For the case of Hong Kong Land, they actually not going to point any more new money into development business. So basically, they're not going to buy new land, right, to redevelop them and then sell them. And this business, I think if you look at the last 10 years, has been quite lumpy. In some years, they do very well, like 2019, and in some years, like 2023, or even like the first half of this year, they have to take a one time off, right, because of the poor sentiments in the property market in China, because 2/3 of the business on development side actually come from China, and China right now is going through the huge property crisis, and that's why the government actually came out and announced a few measures to actually make sure that the whole sector recover, right? But Hongkong Land said enough is enough. They're going to stop investment in this sector, and of course that will essentially remove this lumpy earnings from their business as they stop, pouring money into this sector. Okay, so that's one of the main things they do. Basically, they cut off the development business, and then the second thing they're going to do is, of course, they're going to realize some of this value, right? The asset that they're sitting on right now is actually the current share price that is trading is actually trading at a huge discount. So what they're going to do is that they're going to realize some of this money that's stuck in the development business. I think they're going to unlock like 6 billion come out from this business alone, and then on top of that, the 4 billion will come from the existing assets that about of it actually come from the Shanghai West Bund project, right? So overall, they're going to like recycle this 10 billion of capital, and they're going to unlock the capital, right? And for their existing asset, those that they have like sitting on the central portfolio and also the Singapore side, they might potentially in the future REIT this asset. Okay, or they can create a funds with the third capital that actually is funding it, and then they can manage it as a private,
like a fund manager kind of thing.
Yeah, and then they can actually earn the
fee,
management fees, and if they have do development project, then they will earn the development fees, right? So eventually what they're trying to do is that they want to create more recurring income for the business itself,
with and less assets,
and then and become a asset light type of business model. And of course, with this new, when they announce it, the market loves it, and that's caused the jump in terms of share price. And because on top of that, they also forecasted, or they actually have a target where they set up the vision they want to achieve by 2035, right? They're going to grow the earnings by 2 times in the next 10 years, which means that it's going to grow at like mid-single digit growth to high single digit growth, right? And then they're also going to grow the dividends, which right now they are actually paying about 22 cents. They're going to grow it to become 44 cents by 2035. That's the target that they want to achieve. And in terms of AUM, they are currently managing about 40 billion, which about of it is actually from their Jardine Matheson family owned money, right? And then they're going to grow it into a platform where they will get third-party funds to come in, like sovereign wealth fund, pension fund, insurance, right? They're going to grow it from 40 billion to 100 billion by 2035.
So the capital partners coming in.
So essentially what they're trying to do is that what CapitaLand has done, right, a year or 2 years or year plus ago, right? They're slightly late to the party, but it's never too late, right?
I mean as long as the price went up, it's not too late, I guess.
But to put into perspective, now their market cap is about 10 billion.
US,
Right? The asset that you're going to convert to cash is 10 billion for the next year. So that 10 billion market cap on a 10 billion that's going to convert to cash. On top of that is going to be recurring asset, like focus on RIC, focusing on returning capital back to shareholder. So if you look in terms of the dividend, right, they got also mentioned that 20% of this 10 billion, right, they're going to do share buyback, which is a good thing, based on price, subjective, right? The second one is, right, they aim to pay out 60 to 80% of the recurring income as dividend. So currently, right, based on the latest figure, 2023, right, their investment property, which is their recurring income, is about 984 millions, right, operating profit before tax, right, and the dividend that they give out is about 485 millions. So you divide, right, it's about 50% payout ratio. So that means they're going to increase the payout ratio to 60 to 80%. So you can expect the dividend is not only 22 cents, but higher moving forward.
Will grow over time.
So the target is 44 cents, like you said.
And on top of that, I think the thing about this kind of catalyst is people are concerned is whether they will fulfill or not. But if you look at Hongkong Land, you look at Jardine Matheson, they are all under the same family. They tend to have a track record of shareholder friendly and do the things that they say, right? So if you go to one of their press release transcript, which I have over here, right, to align the management with the Hongkong Land future, right, they actually, based on all this, right, they create an incentive. That means they must fulfill all these criteria. Then the management then can get the incentive. So I think the managements are all aligned and they are moving forward. There's a high probability that they will hit the targets.
So overall, to summarize, it's kind of like CapitaLand became capital investment, more asset-like business, more recurring model. based on fees and rental income and all that. Because I think for those who don't, development property is very lumpy, very cyclical.
Yes, correct.
It takes a long time. So because you build something, it takes years, and then you need to sell it, and then you recognize that. So not a very popular business model for investors.
Yeah, that's why there's always boom and bust on the price to book.
Yeah.
Right. So if it becomes an asset-like model, right, the price to book will usually trade above 1 time.
Okay.
Right, because asset-like companies, they tend to they can realize the value easily.
Okay, so I guess you can say investors can expect Hongkong Land to become more predictable.
In the
business model.
Yeah.
So that becomes more popular, and that may command. It's already seen. We've seen the market reacting to the news. They can command a higher valuation, a higher multiple.
Yeah. But right now they're still trading below the even the discounted book. Their discount is like $6.15. They're still below.
Okay.
The actual book is around, I think, 14.
Okay.
Yeah.
So if you look at the last 4 years, I think their underlying profit before interest and tax, about 70% actually come from the recurring income, which is their primarily rental income, right? And then eventually this will slowly transition into 78% in 2030. 78% of it will come from the recurring income, and on top of that, their new investment and management fee will contribute about 14%. So that will actually push up even higher. While development side of the business continue to, they will continue to fulfill all the existing project that they already have, right? And then, but they're not going to reinvest new money into it. And by 2035, their target is that there's no more development income, but about this actually will be covered by the new investment plus the management fees, which are a lot more recurring. I would say close to 100%.
Okay.
If they can actually execute all this strategy well.
Okay.
Yeah.
So I think someone watching this could be asking, what are the risks that could potentially happen? I mean, you mentioned the execution risk.
Yep.
They may not do it as well, but you said their track record is pretty good. Any other risks you can probably foresee for like Hongkong Land over the near term?
Yeah, I think for now, right now, Hong Kong office market is actually in a tough condition, right? So if you look at the overall supply in the central region, which actually contribute about their portfolio, investment portfolio, about 70% actually in Hong Kong. The current supply situation is a little bit of oversupply, right? I think you are looking at about central office vacancy rate is about 12.1%, right? So that kind of tells you that it's actually a tenant's market. So landlord are having difficulties to raise the rent. In fact, they have to cut the rent to secure the tenant, right? And thankfully, their assets are in the prime location, and they're actually able to attract those tenants who are looking for more prime location. That's why the flight to quality is actually happening, and they're actually able to charge a higher rent versus the current market spot rent based on the data that we have, right? And their current vacancy for their entire asset is only like close to 7% versus market, which vacancy is about 12%. Empty office unit over there. Right? So it's actually they are managing quite well. So I think you can see that the location, the asset that they have is actually shining in the time of crisis. This is a kind of asset that they want to focus, I think, moving forward. Yeah. So right now, of course, you don't know when the whole Hong Kong office market is going to recover, right? Even for a retail side, it's actually still before the pre-riot level, right? So their current average net rent, right? So it's really up to when or how the Hong Kong government will pull through the whole crisis. If you can do that, of course, then there will be a turnaround. If not, I think we will continue to see a slight decline, gradual decline in the average net rent, which won't be good for them because this is a bulk of their portfolio. I think we mentioned this last year, right? The crisis that Hong Kong is actually going through right now.
So I think you think like the Hong Kong market is a bit soft.
Yep.
Yeah, and we are not so sure like over the long term whether Hong Kong is going to be as vibrant as it once was in the 90s.
Yes.
Like Hong Kong was like probably that was the peak of Hong Kong.
Yep.
We're not sure whether that will ever come back. But they have good assets it's still a first class city.
Yeah, first class. Yeah.
All right. So how would you value the stock at this point in time?
I think if we look at last time that we did, I think Victor did a sum of parts, right? Where he actually tear down, he did a net type of valuation. But for me, I just keep it simple. I just look at the price to book. I think the best way to value them is because they are asset heavy type of business. So and they're going to unlock some of this asset, which I think it makes it more relevant to look at their price to book. If you look at the price to book right now at the time of this recording, it's actually trading at about 0.45, right? And if you versus their 10-year average, it's actually trending at about 0.35, right? If you look at their 5 years average, it's actually about 0.33, 3.
Okay.
3.5 there
So
about.
near there,
Okay,
yeah.
so it's slightly above after the recent share price spike.
Run up, yeah.
Actually crossed their 5-year average. You look at the 10-year average, it's still below because 10-year average actually stands at about 0.4 times. Okay, what this means is that for every $1 of their assets, the net worth that they have, the market is actually pricing them like a fraction of it, like 35 cents, 40 cents.
Yeah.
That kind of valuation, right?
Yep.
And yeah, so the recent news, like they're gonna unlock the asset value, gonna do share buyback, pay out more dividend, kind of like revitalize the whole stock, right? And yeah, but right now, even based on price to book, they are still below the 10-year average. And because they are going to realize some of this asset, I think we may potentially see a potential re-rating upwards in terms of valuation. So I think we can actually base on the 10-year average of 0.4 as a benchmark. So it's still undervalued even right now, right?
Would you say that as it becomes a more asset-like business model, price to book becomes less relevant as a metric?
Price to book is still very relevant even for the next 5 years to 10 years because above the asset is still property, right? They are not going to read everything unless when that happens and they become like fully asset-like in nature. Then obviously the price to book, the discount will really narrow down over time. Right, so but I don't see that happening even in the next 5 years to 10 years.
It takes time, right?
It takes time, right? For them, they have to execute their strategy. But Hongkong Land, you can look at price to book, but because the cap rate in Hong Kong, I think is really like very low. You're looking like 3% to 3.5% cap rate. So it's a bit. The properties are actually on the high side. The other way that you can look at Hongkong Land is of course the yield, right? Which when we talk about it, people say that you get paid to wait, right? At that time, the yield was about
5-6%.
5.5% there about, right?
Then the price to book is about $1 you're paying for 20 cents.
Okay.
So right now, if you look at Hongkong Land, their yield actually has gotten or fallen below 5%. Right now, it's actually trading at 4.5%, right? Based on the share price of close to $4.9, right, dollars, right, at the time of this recording. So the yield comes out to be about 4.5%. It went up to as high as I think 8% at one stage in 2024 when the share price dropped to $2.80 over. Right, but then it has share price has been increasing, so the yield has naturally been declining. Okay, so if you look at the current yield now, it's about 4.6%. Right, so there's also one area that you can look at, right? You get paid 4.6% to wait for the management to execute all this strategy to become a more asset-like type of businesses, and more recurring, and then potentially higher dividends.
Yeah,
in
then
the
your
future.
yield on cost will increase.
Yes.
If they are successful at raising the dividend sustainably.
Yes.
Yeah.
Yeah. So that's for Hong Kong Land side. But some of you may feel that, in the case for me is that, the rebound is way too fast, right? Because these are just a plan right now. Nothing has been done yet. It's still a plan. I believe they'll execute it, given that the background of the CEO, right? Mapletree Investment, where Mapletree Investment have a few REITs under the umbrella. So I believe the people are there, right? The right people are there, and it's just a matter of time when they will do it.
Okay.
Right? So Singapore asset looks like a good. Maybe they can take a first move there also, right? Because now Singapore REITs market is very vibrant. Office is doing very well. The office asset in Singapore is doing very well, right? So it would be a good time for them to really like monetize this asset, right? But the other way that I can actually, offer the insight would be like, instead of looking at Hong Kong Land, maybe you can potentially look at the parent company, Jardine Matheson, which I think they own about 53% in Hong Kong Land, right? And the shares were beaten down really badly. And of course, recently with the Hong Kong Land announcement for strategy review, Jardine Matheson did quite a run up a little bit, but it's still manageable, because if you look at the current yield for Jardine Matheson, is yielding at like 5.8. Yeah, 5.7% to 5.8%.
Okay.
Right. Versus Hong Kong Land now is actually fallen below 5%. And their payout is also still quite healthy. I think at about 60 to 50%. Right. And you also get paid to wait. While the subsidiary, the Hong Kong Land, is trying to unlock the asset, the beneficiary will also flow to Jardine Matheson.
I mean, if you got concern that you don't want to purely in property play, then you can look into Jardine Matheson, because it's more diversified. You got the rest of the other assets together with Hong Kong Land. Yeah,
so you look at the Jardine Matheson, they are very diversified, right? They have Astra, which have a heavy exposure in Indonesia market, Hong Kong Land, right? And of course, you also have like Jardine Pacific, Jardine Motor, then of course the Dutch Dairy Farm, right? Jardine Cycle and Carriage, and Marina Oriental. So it's a very diversified basket. So you are not like 100% exposed to like Hong Kong, where I think about their assets are actually in. Okay. So you still get to benefit of getting paid
And you get a higher yield.
5.5%.
Yeah.
Right, but of course, having said that, we have vested interest in Jardine Matheson.
Okay.
So you need to do your homework, and of course, discount 50%. What we say here, right? Because I find that in terms of valuation, which is more attractive? If you ask me, I would say that Jardine Matheson, because it pay better yield.
Okay. But some people may prefer a pure play.
Then if you want a pure play, then Hongkong Land will be
Hongkong Land. So it really depends on your investment goals, what you actually like. But at this point, Jardine Matheson looks like a more attractive option because of the higher yield.
Yes.
Less concentration risk.
Yeah, of course, this is value only at the time of this recording, right?
Yeah.
Price may change by then,
so
we don't know. And again, it really depends on you, and it's not. This is not a recommendation to buy.
Okay, so no recommendation to buy, sell anything. We're just sharing our analysis, how we value the companies, and what happened with Hongkong Land recently that caused this catalyst to like push the share price up. So we just want to cover all of that, especially for those who have been. I think a few people do ask about Hongkong Land from time to time actually. Yeah. And Hongkong Land has been on our watch list for a long time.
Yeah,
long time.
And I mean, we covered it 1 year ago. Now we're covering it again. So whenever there's things that are happening with a stock like that, we just want to like pick it up and share what we know.
Yeah.
And it's really up to you to do your own due diligence to find out whether it suits your portfolio. Okay. Yeah. So is there anything you want to share about Hongkong Land at this, anything else?
Hongkong Land, it's both Hongkong Land and Jardine Matheson, they are both traded in US dollars.
Yeah.
Right. And so it really depends on you. But if you're not comfortable with Hong Kong, have exposure in Hong Kong, China, or even Asia Pacific, right? Obviously, Hongkong Land and Jardine Matheson may not be suitable for you. Then you should just stay out.
Okay. All right. Okay. So it's listed in Singapore.
Both is listed in Singapore.
Okay.
And I think Jardine Matheson also listed in the London Stock Exchange.
Okay. Yeah. All right. So I hope this was really, really useful especially for those of you who are looking at Hongkong Land, and also for dividend investors who are looking for yield. This is one of the plays that we prefer actually. So again, we have a vested interest in Jardine Matheson, just to declare that. Please do your own due diligence and decide for yourself. All right. So is there anything else you want to share?
Nope.
That's about it?
Yeah.
Okay. So my name is Adam, Rusmin, Victor.
Thank
Thanks
you
so much for joining us. Any questions about Hongkong Land, would be happy to answer them. Jardine Matheson as well. And of course, if you like this roundtable, please hit the like button and subscribe to our channel. Many more roundtables coming up, and we'll see you again.